What is up, people? Miles here with Keep the Change. Today we are talking about 3 growth stocks that I am buying or about to buy. Should be a very informative, educational, and amazing video, so I hope you enjoy. All I ask is that you hit the like button and the subscribe button, and if you don't, well, Freddy Krueger is going to come in your dreams tonight. You're not going to like it. First stock on the list is Chegg. Now, if you're a student, you've probably heard of this stock or this service. Chegg is basically an online tool, an online website that students can go and use in order to go and answer their questions. You can post a question onto their service and somebody will come answer it, an expert in that field. So if you have a math question, you post a math problem and hey, they'll answer your question. It also has textbook solutions. It's basically a service in order to help students study, but really it's to help students cheat. Speaking from personal experience, of course. Now, if my school sees that, I'm not a cheater, okay? Glad we got that out of the way. But Chegg has a lot of different services. You can get textbooks on there. You can check out Chegg Study, which is having tons of homework and textbook answers, as we mentioned earlier. It's got a math solver. It's got 24/7 tutors you can talk to. It's the whole ordeal. It's the real thing. And as of June 30th, 2020, Chegg had 3.7 million paying subscribers for its services. So clearly there is a lot of hype for this product. And just speaking from anecdotal, personal experience, I've heard a ton of people talk about Chegg. I've used it myself. It is actually a great resource. It always has the textbook answers I'm looking for. If I just search in a question, somebody's answered it already. So there's around 36 million in the US who are in high school and college, and around 18 million in the UK and Australia and Canada and other places that Chegg is mainly targeting. So when you think about it, 3.7 million subscribers isn't that many in the grand scheme of things, and they still have a huge growth market ahead of them. Now, the brand is already very big, as 87% of US college students have heard of a Chegg service. However, just because you've heard of it doesn't mean you've used it, and when you do use it, you're really going to see quite a difference, maybe in your grades, maybe in your study habits, whatever the case may be. You might just find that you're a better student because of this service. So a big growth engine for them is obviously outside of the US as well. And in their latest earnings call, they basically talked about how they were surprised at how much people outside of the US were actually trying to use the service and adopt it as well. So not only is this predominant in the US, but it's going global. So this quarter, which was basically April 2020 to June 2020, Chegg managed to grow revenues by 63% year over year, which is absolutely ridiculous. That is insanely high growth. Now, a lot of this is due to the pandemic. A lot of colleges, a lot of high schools, all of their learning is online now due to the fact that, they can't be in person, obviously. So what do you do when you're online and you have no teacher to help you? Go to Chegg, you find the answers, you study those answers, all that good stuff. This service is really an online service. So the fact that school is now going even more accelerated towards online learning is actually a really good thing for Chegg in general. On top of that, the company just turned profitable basically this year. And that to me is an extremely good sign, because for years they were unprofitable, but now they're making so much revenue that they can have net income as well, which is extremely important to me. Not only do I want revenues to be growing, but I also want net income and profits to be growing as well in order to invest in a company. I'm not trying to invest in a company that's growing revenues at like 70% per year, but it's still losing massive amounts of money. No, Chegg is different. It's actually making money, and that is something we like here. Now, the balance sheet is pretty good. It's not anything spectacular, but it's pretty good. So they have 742 million in current assets, which basically means those are assets that they could convert to cash within the next year. And they only have 90 million in current liabilities, so basically they have to pay off 90 million in the next year in order to keep the business running. So clearly they have enough current assets to pay off their current liabilities, which is a good sign in a company. You really want to see that. It should be okay financially, and since they're actually growing profits as well, the balance sheet should get better. They should get more cash over time. Now let's look at the valuation of this company real quick, because that's actually what's really important. Chegg stock is trading around $66 right now. It has a market cap around $8 billion, and they have a forward PE of 43. Now, a forward PE of 43, generally speaking, is rich, but for a high growth stock, it's not too uncommon. And on top of that, Chegg is really an insane growth company. I mean, 63% year over year revenue. That is not normal. That's good growth, okay? 20% is considered really good. So imagine 60, right? So even though the forward PE is 43, it's justified because the revenues for this company should be able to grow for the foreseeable future, especially as learning shifts online as well. If this stock hit 60, I would start buying a lot more. If this stock hit 50 or 55, I would buy a ton of it. Yeah, that's basically where I'm at with this company. Has has a lot of growth potential in the future with the fact that they can go outside of the US and expand, and along with the fact that online learning is here to stay and people need to accept that, right? I don't think just because the pandemic might go away because of a vaccine possibly, that online learning is going to be disrupted entirely. I think if anything, online learning is just going to be even more popular in the next decade, which makes Chegg a great play on online learning. Now, the second stock we're talking about is actually Take-Two. So I bet you're asking yourself, Miles, what the heck is a Take-Two? What do they do? Take-Two is a video game publisher, and they're most known for their smash hit GTA 5. Personally, I remember GTA 5 like it was yesterday. It came out in 2013. I was around 13 years old. Probably should not have been playing GTA 5 at that age, but whatever. I turned out fine. Not only do they have GTA 5, they have Red Dead Redemption, they've got NBA 2K, they've got BioShock, they've got Borderlands, they've got Civilization, Space Program. The list is endless, okay? It goes on forever. But what you need to know is their biggest titles by far are GTA, Red Dead, and NBA 2K. Those are what make up the majority of their revenue. GTA 5 being the biggest out of those, selling 130 million copies since its release date in 2013. A lot of people I knew in college as well played 2K. They were big fans of the basketball series. It was a pandemic in itself, or an epidemic. I'm not English, I don't know. GTA 5 single-handedly changed the entire landscape of gaming. You may be asking yourself, well, how did it do that? Great question. I'm glad you're following along with the class. Now, they have an online section in GTA 5, GTA Online. Basically, what they did, they implemented shark cards, so you could buy this little card, you pay 10 bucks in real life, and you get money in the game. It's a cool little microtransaction type deal. Well, ever since then, a lot of games have implemented microtransactions just for business purposes. In fact, it's such a big part of Take-Two's revenue now that it makes up 58% of it. So 58% of the revenue comes from people spending money in the game, not actually buying the game, which is really interesting to take note of. Now, gaming in general has been very big recently. Obviously, the pandemic, people were locked at home, got nothing to do, might as well just pick up a controller, play on your PC, whatever. But that's not going to stop anytime soon. Gaming is obviously going to get bigger as the years go on, and Take-Two has some top-of-the-shelf line games in terms of quality. Now, in terms of this company's actual financial growth, let's look at its latest quarter, which was from March 31st of this year to June 30th of this year. Managed to grow revenue by 54% to $831 million for the quarter, and their net income, which is basically their profit, increased 91.5% to $88.5 million. Take-Two stock today is trading at around $156 a share, and it's got a market cap of around $18 billion. Now let's look at their balance sheet. That's extremely important to me. I want a company with a great balance sheet so I can sleep safe at night and not be scared of Freddy Krueger like you would be if you didn't subscribe. Hit that subscribe button right now, tricked you. So their total current assets is $3.6 billion, which not only covers all their current liabilities, but all their liabilities in general of around $3 billion, which is extremely good. That is basically the best a balance sheet can get. So this company has a bunch of great games in its catalogs where people buy the games, and then on top of that, they spend money inside the games, which earns them even more revenue. But what really excites me is future growth prospects with games such as GTA 6. When GTA 6 launches, that's just going to put the company to another level, into the stratosphere in my opinion. Not only that, but later this year, we all know Sony and Microsoft are coming out with the PS5 and the Xbox, whatever it's called, Xbox 1 million, I don't know. But they're coming out with new consoles, that's the point. And so basically, people are going to go on those new consoles, they're going to be like, hey, GTA 5, might as well play it. So I think they have a great catalog of games, future growth prospects, they're already growing massively. And then on top of that, they have a fantastic balance sheet. So with all that being said, let's look at the valuation. Now we got a forward PE here of 40, which is considered rich, especially if you compare it to its counterparts like Activision or EA, which usually trade at around 20 to 30 forward PEs. However, Take-Two actually does have more growth in store for it than those two companies, so that's something to keep in mind as well. However, Take-Two's forward PE usually trades at around 25, and now it's at 40, which could indicate that it's a tad bit overvalued here. I am still a holder of the company, and if it dropped to around, I'd say like $145, I would start buying immediately. Now we got the third stock here, Intuit. Are you Intuit? No, okay. Yeah, I'm sorry for trying even. Now Intuit is a tax company, or a financial company rather. And we all know the saying, only 3 things are guaranteed in life: death, taxes, and subscribing to the channel right now, or else you will die. That's guaranteed, actually. I think I read that somewhere. So Intuit actually owns TurboTax, which I'm sure a lot of you have used. I've used it myself. Super simple, easy to use. It's basically for people to do their end of year taxes, or if you're like me and you're a minimum wage worker, get that sweet tax refund money. They also own QuickBooks, which is an accounting service. So if you're a small to mid-sized business, you buy QuickBooks and you can handle all your accounting needs on that platform. So despite TurboTax being already very well known and very popular, it actually managed to have its biggest customer growth in 4 years this quarter. So that's very impressive. It shows that the service is still getting more popular, even though you might think that it wouldn't be. Their QuickBooks revenue grew around 30% year over year, and their total overall revenue grew a modest 13%. However, that's still decent enough growth, and that's why I put it at the end of this video. It's not quite as high growth as the first ones, but you're still getting good growth with this company. And I did make a joke earlier, but the reason I really like this business model is because taxes are something that is never going to go away. The need for accounting is never going to go away. It's just not. It's only going to get bigger as more people are born, as more people take jobs, as the economy improves. Another thing I really like about Intuit is the fact that they're making acquisitions. They just bought Credit Karma for around $7 billion. I think that was a really smart move on their part. If you're on it, then you know you can do TurboTax on that. It kind of helps solidify their ecosystem, sort of like Apple. Once you get an iPhone, you're more likely to go get Apple Music, right? Once you're on QuickBooks, you're more likely to use Credit Karma or vice versa. All that stuff interlinks and makes it just one more streamlined service or company for your financial needs, which is really impressive, and I love that about this company. And in terms of other growth avenues for them, they're rolling out TurboTax Live and QuickBooks Live, and basically what that is it's a 24/7 service where you can ask experts about your taxes or accounting needs. So if I'm having trouble filing my taxes this year for some reason, I go on TurboTax Live and I talk to an expert right away. In TurboTax Live, their customers actually grew 70% this year, which is really impressive. Obviously, that's high growth. So with all that good stuff being said about the company and their growth prospects, let's look at the valuation here. Around $300 here, and it's about a $91 billion market cap. They have a forward PE of around 37. The company trades at a premium just because it's very consistent. It's very stable. Even in economic downturns, this company actually doesn't do that drastically bad. In 2008, it didn't really get impacted as much as you might have thought. So that's why it kind of trades at a higher premium, even though the growth isn't crazy insane like the companies we talked about earlier. And it usually trades at a forward PE of around 37. So right now, this is fair value. This stock has just always been such a hard one for me to buy, but I am going to begin buying it very, very soon, and hopefully it dips so I can add more to my position. So with all that being said, thank you for watching, guys. Let me know which one of these stocks is your personal favorite, or if there's any growth stocks I should be on the lookout for, and I'll look into it right away. So thanks for watching. Love you.